often hear that saving for retirement means having a long-term investment strategy. But the reality is that that's not easy to do when we get bombarded with a lot of information about what's happening at the moment, especially from the news, from radio, from TV. It's very difficult to make sure that we stay focused on the long term. So it's very useful to take a step backwards and actually take a look at how the long-term history of investments and assets has actually evolved over time. So we took a look at just a handful of graphs to take some lessons from the history of investments. The first one that we know is important, but it's often difficult to do, is to have patience. We live in a world where instant gratification is something that we get used to. And investing for the long term is obviously not about instant gratification. It means being patient to let compound interest work its magic. Just take an example. If you invested 1,000 Rand at the end of 1974, so we're talking a long time back, and you invested that in the stock market, today it would be worth 1.4 million Rand. That sounds like an astonishing amount of money for an investment of 1,000 Rand. But that's the beauty of compound interest. However, what's also important is, other than patience, is to actually have a bit of courage. In other words, it's better to be invested in the long term in the stock market. Why? Because the returns from the stock market, even though they can be volatile, they can go up and down, it can be quite a bumpy ride, but in the long term, 1,000 Rand can turn into 1.4 million. If you'd invested that same 1,000 Rand in a bank account back in 1974, it would only be worth 131,000 Rand. So even though that is a substantial increase, it's nowhere near 1.4 million. And that illustrates the difference between taking a bit of risk and playing it safe. The other thing that's important is diversification. So because the stock market is such a volatile, bumpy ride, you don't want to have all of your precious savings sitting in just that one type of investment. So you want to have exposure to the stock market, but you also want to have some of your money in safer bank deposits. You want to have some in bonds. You want to have some in property. And importantly, you also want to have exposure offshore, not just to South Africa. South Africa is a tiny little country at the bottom of Africa. It's less than 2% of the world economy. So you want to have exposure to the other 98%, where interesting companies are making money and making their investors money. And then finally, you actually want to invest in knowledge, your own knowledge and understanding of investments. It's not enough to say, I'm not an investment person, I don't understand this stuff. The reality is we all have to save, and it will pay you to invest in upskilling yourself on investments. Even if you don't become an investment expert, having some knowledge of what is worth avoiding, what is worth investing in, the kind of risks that make sense versus those that are obviously have the potential to lead to a scam or something where you lose a large amount of money. You need some knowledge to be able to tell those apart. And so those are the 4 lessons that we picked up just from a bit of an analysis of many decades of investment market.